Hello everybody. Today we are here with Giorgio Costantino, Global Transformation Services Executive Director of CRIF. And we are here to talk about the actual context of the integration of ESG logics and assessment in the evaluation of credit risk in the banking sector. Nowadays, Giorgio, the regulatory context and landscape is pushing a lot toward an integration of ESG logics into the credit assessment of companies. How comes that banks are actually approaching it and regulation is so strict in this moment?
Thanks for the question. I'm very glad to be here. Banks, as you know, work in a regulated environment. And every time I speak about ESG around the world, I say Europe is a benchmark in terms of regulation. And this will, to me and to us as CRIF, will help and support the real boosts of the ESG evolution overall, either for banks and for companies, because banks are the lenders and companies will receive money from the banks. And so considering this boosting activity, banks will be absolutely the boosters. And ECB and EBA will be the real boosters because European Central Bank and European Banking Authority are boosting and are asking to banks a very big transparency in terms of ESG. They are asking to measure certain and specific KPIs. They are asking to calculate the green asset ratio. This means the level of compliance of their activities that are loans in comparison with the overall asset of the bank. And so for that reason, banks are already working to try to drive the transition. The main measurement that ECB, ABA are asking to banks are the physical risk, given the potential damages that you may have if some perils will occur, the transition risk to evaluate and to calculate and to measure the cost of the transition toward a low carbon activities, and finally taxonomy. Whenever you may find different kind of things, again, the physical risk analysis, but also some kind of other measurement, like the biodiversity, for example.
But how do you see this integration of ESG risk into credit risk, both for implementation in terms of banking and also with respect to the companies that needs to adapt to such a change?
So as I said before, banks and regulators together, they are strongly interested in transparency. They have to show that they are calculating, they are measuring the impacts of some kind of KPIs, and mainly, as I said before, physical risk, transition risks, and part of the taxonomy that is comprehensive of also of these two risks. But for sure the next step will be to evaluate line by line, loan by loan, credit line by credit line, let me say the ESG compliance of each loan. There's a potential correlation between ESG compliance and credit risk. CRIF has already showed that part of my department did this kind of analysis in the past. We are still updating those correlations. What does it mean? This means that ESG greener counterparties will be good payers as well. And so there is a positive correlation, no? As I said before, between ESG and credit risk. This is showed by the data. We as CRIF did it, and we showed to the banks, but there is not still at the regulation level, as I said before, a commitment to introduce these parameters to calculate the capital requirements.
Given this context, it seems like a nightmare for banks to be compliant and to develop such as a structured approach to the integration of ESG risk into credit risk.
Because banks will, first of all, try to fulfill the information gap. And the keyword, there are several keywords. When I speak to some clients and to some banks, there are several keywords. The first keyword, it is data. You need to find out to collect data. Maybe you interviewed my colleague that we have solutions to collect directly data from the companies. But as I said before, mainly within the financial institutions, there are several estimated data. So the other keyword, it is to have a strong methodology. A strong methodology mainly to estimate those data that will be forever estimated. The physical risk is one of those KPIs that will be absolutely estimated also in the future. So the second keyword, it is to have a strong methodology. The third keyword is granularity. And the granularity, what we say the single name analysis, is what the regulators are requiring to banks and financial institutions in Europe. And this is very unique, because I saw several portfolio analyses also out of Europe, but in Europe, regulators are asking to banks and to financial institutions to evaluate line by line, credit line by credit line, loan by loan, the impact of the mentioned KPIs. Mainly, as I said, physical risk. And maybe I can add finally the flexibility to try to sail into that storm, to try to put together all the different data sources. Think about, for example, the calculation of biodiversity. So you need to link to other kind of data sources, the forestal protected areas. So also flexibility.
Thank you, Giorgio. Thank you for your answers. You have made it clear, crystal clear, which are the challenges and the benefits that faces this kind of revolution in the integration of ESG risk into the credit logics. Thank you again.